As a participant in your company's retirement plan, you have three basic decisions to make. Number one, how much should I save? Number two, how should it be invested? And number three, how would I like for it to be taxed? In today's video, we're going to focus on the tax options that you have inside your retirement plan, a decision that could have an incredible impact on your future finances. The traditional deferral is by far the most common. It is pre-tax. And in fact, if you were automatically enrolled in your retirement plan, you were most likely automatically enrolled in the pre-tax option. Pre-tax means that you get a tax deduction today for anything that you personally contribute to your retirement plan. So for example, if you earn $100 and you save $10, the tax withholdings on your paycheck would only be assessed to $90 worth of income. Now, we would expect the account to grow with future contributions and investment earnings. And in retirement, when you go to take distributions, the distributions are reported as income and taxable to you then. The other option is the Roth option, which is basically you electing to forego the tax deduction today. So to go back to our previous example, if you earn $100 and you save $10, the tax withholdings on your paycheck would still be assessed to $100 worth of income. Now, as with the traditional, over time, future contributions and investment earnings would ideally cause the account to grow. And if you follow all of the distribution rules, then in retirement, when you start taking distributions from the account, every bit of it, contributions and growth, are all tax-free. Now, there's a couple of things you want to consider as you evaluate which may be best for you. The most obvious is the tax rate. What is your tax rate today, and what do you expect it to be in the future? Will it be higher, lower, or the same? The second consideration I actually consider more valuable and most often overlooked. Ask yourself how much time you have for this account to grow. How much time do you have between now and retirement? You see, the key benefit of the Roth is that all of the growth can be tax-free. So the more time you have for that account to grow, the better the tax advantages of the Roth. This is why, generally speaking, we like to recommend that plan participants under the age of 40 contribute a Roth deferral so that they can get the compounding benefit of the tax-free growth. Now, there is a common misconception we need to go ahead and address. Many of you may think that you earn too much money to contribute to the Roth. And while, yes, there are income limitations on who can contribute to a Roth IRA, there are no income limitations on who can contribute to a Roth 401k. So all of you are eligible for the Roth if you decide it is best for you. A couple of other things that I want to address, a few key differentiators. If you're nearing retirement, the phrase required minimum distributions may be top of mind. At a certain point with your traditional 401k, the government does require you to begin annual distributions. There is no such thing on the Roth 401k because you've already paid taxes on the account. There aren't rules on when you have to start taking distributions. The other thing you want to consider is there is something called a 5-year rule to the Roth, which requires the first contribution to at least have been in the account for 5 years in order for it to maintain its Roth status. A couple of other frequently asked questions that we'd like to address. If your employer provides a match and you elect to do a Roth deferral, you are still eligible for the employer match. It would go into the pre-tax bucket, but you would still get the match. Secondly, the investment options are the same. You can choose one model for both accounts, and in some instances, some providers will actually let you invest your Roth money differently than your pre-tax. But for all intents and purposes, it's the same fund lineup. And then finally, the taxes that reflect the Roth contribution should be automatically adjusted for on your paycheck. We are often asked if you do the Roth, if you will expect a higher tax bill in the spring, and ideally and typically you would not, because it should be adjusted for on your paycheck. Hopefully, this video provided you the information you needed to properly evaluate the two decisions. Of course, there's many nuances we didn't discuss, so make sure you do your research. But ultimately, the important thing is that you recognize you do have the ability to decide how you want your retirement account taxed, and you take the time to evaluate the best option for you. My name is Jeannie Fisher. I'm a certified financial planner and retirement plan advisor with Strategic Retirement Partners and also the 401k lady. If you have a question regarding today's superhero topic or any other question related to your personal financial situation, we invite you to click the link below to connect with the superhero education team here at SRP. We are financial advisors and planners who are here to help you make financial decisions with confidence.